Hey everyone, hope they're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and/or financial topics. So let's dive in, take a look, see what's going on today in social media. If you want to follow me, it's at @Finance. And if you want to join our community, finding-value.com, where I dive deeper into all of these topics, sectors, looking for potential investment opportunities and sharing those opportunities with everyone in the community. You can get a special or a discount using that code in the corner there, special, that works on both the monthly and yearly memberships. Starting off with oil. We are living in a phase of low investment in oil and gas. And the longer this period is, the more painful it's going to be over the coming years. Some are, regardless of that, investing, fortunately, but we're very few who have invested in capacity. The reality today, we're losing capacity. If you look at the world's capacity, that number is going down every year. So why do we have such low oil prices? Well, sentiment driven. I know Bissent and Trump have been focusing on lower oil prices and lower interest rates, and I'm not sure if they're going to get either one of those. But there's been a lot of talk about lower, lower, lower. We've had spare capacity in the system. We probably have, I'm not exactly sure what spare capacity we have at this exact moment. Before, I think we maybe had 2 million barrels per day spare capacity. I'm not sure if we've increased production to eat through some of that spare capacity. I know they've raised quotas, but that doesn't mean they're raising production. Quota is the ability to produce, not the actual production. So I'm not exactly sure how much spare capacity is in this system. But when people figure out that there isn't as much as maybe anticipated, and if the capacity is declining at the same time that demand is going up, you're talking about the world's most important commodity going up if when people figure that out. Gold Silver HQ says inflation isn't a bug in the system, it's the deliberate theft by government monopolists eroding your savings. Yeah, pretty much. Pretty much. It's the design of the system. That's why so many wars occurred back in the day about the design of the system. And they put that in place in 1913. And guess what else came about in 1913? Federal income tax. Why do we have that? So we can pay interest on the money that gets created from nothing from a central bank, which is private. Then they run the economy through interest rates. They control the money supply. They control everything, and they can manipulate the system through the supply and destruction of credit. And that is exactly what we have. The design of the system is a credit-based system. And they're not going to teach you this in school because, well, they control what they teach you. History is written by the winners, and the winners determine what they decide to teach you. Value seeker, if oil enters a bull market, what at some point should happen, given its fundamental undervaluation and the lack of capex in the field, inflation and subsequent rates could rise quickly. That's correct. That's why Trump and Bissent want to keep oil prices down, is because they're trying to get interest rates down. And right now we're seeing a divergence between oil prices and interest rates. Now, which one's right? I think interest rates are right and oil price is wrong. So this is the M2 adjusted oil. It says, are we in February of 2002? Oil's price movement since 2015 has been relatively similar to the period of 92 to 2002, during which oil bottomed in 98 at a price today equivalent to $52. So this is what they've got for that. I'm gonna put this up here. So that's crude oil divided by the M2 money supply. And then this is what they're looking at, is this this area, they've got this big move there is this big move there. So they actually, let me do US oil, gets me more data here. US oil. So that's US oil there. And then if I put it in line, you can see all the data. What I'm looking for is a squeeze. Get a little bit of a squeeze going on here, if you see what I'm seeing. Squeeze in that corner, baby. Squeeze right in there. Yeah, this is going to be explosive when we get out of this thing and start to break. We're at a very low point for U.S. oil in relationship to the M2 money supply. At bottoms, you generally see a shoulder, a head, and a shoulder. Then when this goes like this, it's game over for the system. It could be. Interest rates are going to go up, and that's why we're seeing interest rates breaking the 40-year downtrend. This thing is all squeezed to get out. We can also see this squeeze in U.S. oil divided by the S&P 500. There's that same squeeze occurring. What this is, there's a twofold thing here. And then again, this is always subject to what the person understands about the market. And it doesn't mean that I'm going to be right in saying this, but I have a feeling that financial assets are going to get absolutely slaughtered. Slaughtered. Oil and precious metals are going to be the most valuable things on this earth, and copper and other materials coming very, very soon. The beginning of that move is coming very, very soon. We're all squeezed up into this pattern here. What this is it's basically the beginning of the Federal Reserve banking system that started back here. We've had these big spikes coming into a corner here. We've also had a big decline in interest rates for a good chunk of some of this time. When that money rotates out of financial assets, it's going to move into the hard asset category. And that's where I think we get the big moves in our commodity bull market, which is about to occur at some point here. Could be over the next year or so, where these big moves really start to take hold. It'll be a glorious thing when it does occur. Coming back, lithium carbonate, 12-month trend, the 3 short-term rebounds seen. Look at what we have here. Lithium carbonate is starting to bottom and turn higher. Is this the beginning of a bull market? I tend to think so. I'm positioning for it. And if you guys want some ideas around this, definitely hit up the website. But yeah, I think this looks good. I think it is bottom. Gold to silver ratio, 88-1. Historical, 15-1. Mining ratio, 1-7. Available above ground, 1-1. Just saying. And this is the cheap era over here. And you know what else this was cheap for? Look at the dates here. Just look in particular. 1920 is this date right here. 1920. What did we just look at? Oh, look at this. 1920. Really, it all aligns with this big decline where financial assets basically outperformed hard assets, and silver and oil and all of these commodities are probably the cheapest they've ever been against a lot of these other things like gold. Here, we can do US oil divided by gold too. Show you guys what that looks like. XAU USD. And that is also incredibly cheap for oil divided by gold. And we've got these big falling wedges that are just right for a move higher. I mean, it is right. Coming into another one, Lithium 2030 outlook. Benchmark mineral expects. The base case is 3 million tons, 54 billion investment needed. Best case is 5 million tons, 116 billion investment needed. His view, base case is closer to 4 million tons. Even with partial investment, we're looking at 1 million to 1.5 million ton supply deficit in 2030. If or when a 1 million to 1.5 million ton lithium supply deficit hits, we could see spot prices retest all-time highs. at least for a short term. What's critical now is bold investment across the lithium supply chain, mining, refining, and recycling. And this is the big surge. The case for lithium demand is a strong one coming up here. And this is lithium demand surge. Lithium demand is set to surge from 2020 onward. Boom, boom, boom. What is happening in Japan? Treasury yields in Japan have silently surged to new record highs, with the 30-year yield hitting 3.2% today. Japan's 30-year government bonds have lost 45% of their value since 2019. Is it too late for Japan to rescue its economy? I don't think it's the economy that's necessarily driving this. I think it's a combination of the debt they have, and then that is compared against the GDP of its economy and its demographics, the ability to generate GDP. Everything in our system is dependent on the ability to generate gross domestic product. And everything about gross domestic product, for the most part, is dependent on the size of the demographics that are coming through home buying years, having kids, buying more crap. It's really what it is. In Japan, their demographics have not really been conducive to growing GDP. The new fast charging batteries require a lot more silver, and 4 times in 10 years. There's already a major silver shortage being talked about finally in the press too. Supply of silver is very inelastic, and Mexico is blocking new mines. It's an insane setup, and this is global battery demand to grow fourfold by 2035. BNEF chart, global battery demand for electric vehicles and stationary energy storage. This is some of the things that I want to be exposed to. What I'm doing is I'm looking at the raw materials that go into batteries and other things around it, whether it's moving electricity like copper. So copper, silver, nickel, and you could say lithium for some of the batteries. I don't know if lithium will be the absolute best pick, but I want exposure to it. Doesn't mean that I'm going to put all my portfolio to it. I just want exposure because these are what I think is coming is the biggest trend in the markets and the economy coming up is going to be energy related. And I think we're going to have problems in oil. I think it will spill over into other markets. Like we're going to have problems in electricity, even without oil being in a problem. I think it's all just going to dump and pile on to electricity demand. Oil will also have some major issues, which will spill over into nat gas and coal. There's going to be a whole bunch of stuff. Ammonium is going to be a good play. So I want exposure to batteries. I want exposure to transporting electricity, which is copper. I want exposure to the fossil fuels, which are the best generation of electricity for the cost. So I want exposure to all that stuff. This is demoralization propaganda meant to stop men from even trying to start a family. And it says this is the income needed to support your traditional wife fantasy in 2025. And these are the incomes that somebody put together to support that. What I did is I looked at history and I said, you know what? I need to buy a house during a certain time frame. So I knew essentially that I was on the front tip of the millennials, which is a big home buying demographic. And that home buying demographic coming through home buying years is going to raise the price or raise the demand for homes, which it did. And what we're seeing is we're seeing a squeeze in everything in real estate. Rental prices are up, home prices are up, and that big demographic is squeezing everything. But this here is probably based off the most recent home prices and interest rates. Interest rates are the big driver of affordability. Home prices are also a factor of supply and demand. Silver's breakout from a multi-month rising wedge and successful retest so far. Yeah, that looks pretty bullish here. We're just doing a retest on top of the breakout. Looks good. This guy sold some Savanier with 106% gain at 857, letting the rest ride. I mean, just an FYI, we participate in Savanier. We bought it in the fours and threes. Fours and threes is where the majority of us bought a good chunk. Maybe some people got it in the five, a little bit in the fives too. Would I sell here? I wouldn't. I would not. I would hold on. There's nothing here signaling that I need to get out of it. Now that doesn't mean that that we're not going to get a short-term pullback or anything like that. It's gone up, a good chunk in a very short period of time. But you can't make 10 baggers if you sell. He's not selling all of it, but if you sell the majority at 100% gain, you're definitely missing out if it's going to be a 5 to 10 bagger, which I think it is off of its bottom for sure. Platinum's cheap, palladium's cheap. They look absolutely excellent to move higher. Gold's moving higher. There's no reason for me to sell anything here. It doesn't make sense to me. Here's Tim Hack. He says the current portfolio, heavy oriented towards silver and commodities. I did 40 trades today. I sold names and bought new ones, trimmed or doubled down. So positions can change rather quickly. No 31, 33 are call options. The portfolio is up 134% in 8 weeks. Looks like he's definitely on the silver train, as these are all silver companies for the most part. This can work really well if you're right and you time it well. You can also blow up because most of these companies are all junior silver mining companies. So he's really concentrating his portfolio in one sector amongst companies that are all junior companies for the most part. He has a little bit of rare earths, I see, and a little bit of palladium. But it's very focused, heavily focused on silver junior mining companies. I tend to not do that. I see a lot of retail people do this. They concentrate their portfolio because they're trying to time the market. That's basically what he's trying to do, is time it. Sometimes it works out incredibly well. It looks like it's been working out for him the past 8 weeks. What I'd rather do is not be as concentrated. That's me. And I tend to spread across what I think are the best companies, buying the best value. And my portfolio doesn't go up as much in that type of time frame. But I also have good downside protection. Some people will say diversification is diversification. Others try to time the market and they really concentrate. I don't do the concentration. I've found that you're never going to time the market perfectly. Sometimes these things can chop sideways for a little bit and people get frustrated, especially if 100% of their portfolio or close to it is exposed to only one sector. You'll also experience just massive pullbacks. So, I mean, if we don't get a big run here in silver and some of these pull back 20, 30, 40, 50% in a week or two, those gains can vanish quite rapidly. So I like spreading out across multiple sectors where I don't get killed in any individual day unless you get like a total market sell-off, which basically everything correlates to one, and then they all sell off in those types of events. But I kind of spread it out. But I just see this it's very popular amongst retail for people to do this. They get all sorts of bullish. They get some, I don't know if it's fear of missing out or whatever, and then they just pile into one sector, everything they've got. And this is all the juniors. I mean, he's taking literally a lot of risk. Now, is it a good time to do that? I would say, yeah, it's a good time to do that. I think he's appropriately reading the market and trying to time it. And it looks like this would be, if there would be a time to do what he's doing, yeah, I do think this is a pretty good time to do it. That doesn't mean I would do it. I wouldn't put it all on one sector, all on junior speculative mining companies, but maybe it works out really well for them. The number of first-time home buyers in 2004 was nearly 3.2 million, according to NAR. That number is now 1.14 million, and they're all renting. That's why the rent is so expensive these days. One day you will wake up, and there won't be any more time to do the things you've always wanted to do. Do it now. Says Paulo Coelho. I think it's time for emerging markets to make a nice run, especially on a relative basis, says Kevin. Emerging markets are at a turning point. EM stocks are cheap versus history, cheap versus developed. There's the ratio of where we're located. I would completely agree with them. I think emerging markets looks absolutely excellent. Very, very good opportunity. You know what else does real well when these usually go up? Silver does, and oil, and all the commodity complex. So, keep in mind when we look at these charts, this is also a function of commodities. Like, not a function, it is a more supporting data that a commodity bull market's coming is when emerging markets start to outperform. And you know what the major thing is? Weaker dollar. Weaker dollar. The world's used over half of its endowment of oil, yet demand continues to soar. Oil is in the 60s, doesn't work for anyone. Yeah, I'm well aware of it. It's such a great opportunity in oil. It's unbelievable. Unbelievable. People are still way too bearish on silver. Technically, we are still in a consolidation phase. We are about to leave to the upside. We just blew through the 2012 high, and it's holding above. We will see a nominal all-time highs for silver in the next coming weeks. Be prepared. I agree. Totally agree. I think silver's ready to really take off. It's been taking off. We're above the critical resistance support level of 35. And now it's just a matter of time. We're just waiting for buyers to step in and push it on up. Grady says, you saw the big move in silver miners lately. The chart below posted 2 months ago nailed it. Just like with the metals, playing miners is all about timing. Posted the ratio chart 2 months ago in the linked post below at the very lows, at the very false breakout. And we did the same thing. We've been buying silver for months, months ago. We've been taking positions at lows. Some of them are up over 300% at this time. Some of the junior mining companies that I would say the majority of us hold. So these opportunities are very, very rare. So do not miss it, and do play it right. When the bull resumes, like gold and silver now has done, it is vital to change mindset. One cannot play a bull with a bearish mindset. And if you doubt the bull, you will not be able to change the mindset, which means you will not be able to make good use of this bull market. You have to believe in the bull, or you end up being victim of the wall of worry, i.e. your own emotions. And most do need help with this. And again, this is SILJ versus GDXJ, and there's SILJ coming off that bottom there. This was probably in April or so, but this looks really, really good. Huge potential move coming in SILJ. Now, we were in a downtrend in these other markets here. I'm curious to see what happens when we go and break all the way up. And if we break the big 45-year cup and handle pattern in silver, GDXJ could be flying higher, while SILJ is a rocket ship. I mean, it could be ridiculous returns because this is obviously relative valuation. And if GDX is flying higher, SILJ is rocketing. I think that's coming. But that's also why Tim, I think, has taken on all of his portfolio in a bunch of speculative silver companies. It's probably because of where this is located. If you think silver at 40, 50, 60 is the end, think again. It's barely the beginning. Silver should fly after the stock markets have bottomed in 26 or 27. Think 100, 200, and you'll be a lot closer to the mark. Yeah, we're coming out of this big pattern here. the 45-year cup and handle pattern, and we're going to shoot way above that. I agree. Now, are we going to get a pullback in 26 or 27? I don't know. I really don't know. But all I can say is the charts look really good for silver. Here's platinum. So I've been posting that platinum will break out hugely soon. And now it's happened. Now have big breakouts on weekly, monthly, and quarterly timeframes. We also have a yearly breakout that's in the making. It means the secular bull market for platinum is now resuming, as expected would see. I've been saying since 2020 that platinum will outperform both gold and silver in this bull market. Do not miss this historical platinum palladium bull market. Many have started to wake up to platinum and palladium and say they saw it coming, which they did not. But with us, we've played these sectors for decades. So, yeah, we've got the huge breakout on platinum for the quarterly. It's a big secular bull market, and there's the second leg, the first leg, and then the second. So, yeah, we're going to go way up in platinum and palladium and silver. They're all going to rip. I've been a huge bull on platinum ever since 2020 on this false breakdown. That's where I've been a bull, watching this for a very big breakout. Here is Kevin. He says, my definition of a sure double. A stock, do a deep dive on and think it has 100x potential. They are rare, and I like to bet heavy, typically get 2 to 3x. Then decide if I should sell a half to a third and get my initial capital back and have a free quote option. But when you know a company well and you do a deep dive, the news flow that typically gives you the first double can sometimes make you buy more instead of taking profits. This is the path to life-changing plus 10x returns. The best investors I've come to know like to build portfolios with core-focused certainty and a bunch of 100x lottery tickets. That's your asymmetry. I have a very similar approach. I identify fractals or big movers in wave 1. I try to buy them at the bottom of wave 2 in a big bull market. Generally, wave 1 is an indication of what could occur in wave 3 and wave 5. And that's where your life-changing gains come from. They come from those middle to end of the bull markets where they really move. Sometimes they come in the beginning too, if you're coming from ludicrously low valuations like we did in oil and gas exploration production companies. But my approach is very similar to Kevin's. My portfolio allocation is dependent on the perceived risk I have of the sector and companies, I should say. Peter Brandt says there is one reason why stocks could continue to advance. Long stocks is really a short USD play. Stocks are a short play on the dollar. Stocks are expressed in USD terms. Fiat destruction would send stocks through the roof. And these are the bull markets for commodities, are those sideways actions. Are we going to get a sideways action where we get a big bull market in commodities? I think so. I think so. This is the ratio chart. Few are watching, but everyone should probably be watching this. DBC divided by VU, which is commodities versus stocks. For decades, falling input costs plus globalization equals margin tailwinds. Now that tide may be turning. We're electrifying everything: EVs, AI data centers, grid and defense, reshoring. But this shift runs on materials: copper, uranium, silver, lithium, oil, platinum, palladium, rare earths. And we've underinvested in all of them. AI may boost productivity, but it can't code copper. If input costs rise structurally, not cyclically, what happens to valuations, margins, leadership? Exactly. This guy has nailed it right here. If the input costs rise structurally, that means a long-term structural shift. And that's what I was just showing with oil divided by the S&P and oil divided by gold. And cyclically means short term. So structurally means if we rise for maybe the rest of our lives. What happens to the valuations of regular companies that are they are all projecting future cash flows with a paradigm mindset of low cost of inputs. If input costs rise structurally, the valuations are way overvalued. That's exactly where my mindset is at. Exactly. So this chart may be bottoming. It reverses. If it reverses, everything changes. This is a double bottom, guys. Double bottom here. You can draw a line across this way. It's a double bottom. And when this moves higher, the entire market will shift. Their entire paradigm is about to get shattered. Because if we go into a structural increase of costs, where commodities go up, which I think it will, that means that the valuations of everything in the NASDAQ and everything in the S&P 500 are overvalued. That also means that interest rates will go up, and we've broken the 40-year downtrend in interest rates. It's all in alignment. And we're all like right at the bottom here. We're right at the bottom. 2020 was the first bottom here, and then we're doing a double bottom. Here's the chart showing mortgage payments for a median priced house by quarter for the past 53 years. Everyone just skips right past the fact that they rose a meager 31% in nominal terms in 38 years before playing catch up. The recent rise is nothing compared to what they did in 72 to 81. So it's a big move here in percent terms. We had this big sideways action. Do you know what that sideways action, what caused that? The decline in interest rates for 40 years. Interest rates peaked here, and they declined ever all the way to about the bottom through around here where they bottomed. And then it went higher based off interest rates. Increasing interest rate environment, declining interest rate environment, increasing interest rate environment. What makes you think that affordability is going to go down in an increasing interest rate environment? Oh, they've got to go down. They don't. Those people don't understand what's happening. They don't understand what's happening. I'll say it again. They don't understand what's happening. Interest rates are a big portion of affordability. And people are going to say, well, how are people going to afford a home? I don't know. Maybe people won't. Maybe less homes will be built. Maybe more people are going to rent. I don't know. Interest rates, in my opinion, they're going to go higher. Now, some people are going to say, oh, well, that means that home price is going to go lower. No, that does not necessarily mean that. Interest rates go up when we have problems with inflation. So I don't know of a single time in history where rapid inflation occurred and house prices went lower, unless we were in like a hyperinflation of some sort, and on a relative basis, home prices are going down against other assets like gold, silver, and stuff like that. Yes. In dollar terms, no, because if someone plopped a bunch of money from high inflation in my account of money, so if I added zeros to my account and home prices didn't go up, I would go buy homes. Like I would buy a house, another house maybe. So I don't see how they would go down if we get a lot of inflation. If commodities are right, inflation is likely already bottomed and could be staging a meaningful resurgence. The reality is that resource prices are reflective. They don't just signal inflation, they help drive it, and their impact spreads deeply through the economy. All this as we watch the potential emergence of a new Fed chair positioned to push rates lower and formally usher in an era of fiscal dominance. Here's the S&P GSCI equal weight commodity sector and the U.S. break-even rate. Morgan Housel, logic doesn't persuade people. Clarity, storytelling, and appealing to self-interest do. That is pretty jacked up. It really is. I hope that I'm governed by logic. And that's what I've got for today. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you like. And that's all I've got for today. So we'll catch you next time. This is Finding Value.